Warren Buffett, the Oracle of Omaha, has built a multi-billion-dollar fortune using time-tested investment principles. But with the rise of AI-driven investing, can machine learning algorithms outperform one of the greatest investors of all time? Today, we're putting AI and Buffett head-to-head in the ultimate investing showdown. Warren Buffett's approach to investing has withstood the test of time, proving that discipline, patience, and fundamental analysis can lead to long-term financial success. Unlike AI-driven investment models that rely on vast amounts of data and real-time analytics, Buffett places his trust in the qualitative aspects of a business. He focuses on factors such as the strength of a company's leadership, its brand reputation, and its long-term economic advantages, also known as economic moats. Buffett believes that a company's true value is not solely determined by stock price fluctuations, but rather by its ability to generate consistent profits and maintain a competitive edge over decades. This philosophy has allowed him to build one of the most successful investment portfolios in history. At the core of Buffett's investing strategy is the principle of value investing. This means seeking out companies that are fundamentally strong but trading at prices lower than their intrinsic value. Instead of chasing short-term trends or speculative gains, Buffett invests in companies with proven business models, strong financials, and a history of steady growth. He emphasizes the importance of long-term thinking, often holding on to stocks for decades rather than engaging in frequent buying and selling. His philosophy is simple: time in the market is more valuable than timing the market. By maintaining this patient approach, Buffett has managed to weather market downturns and economic crises while still achieving remarkable returns. One of Buffett's greatest strengths is his ability to ignore market noise. Unlike many investors who panic when stock prices drop, Buffett sees market fluctuations as opportunities. He believes that short-term volatility should not dictate investment decisions. Instead, he views price dips as chances to buy strong companies at discounted prices. His famous advice to investors is to be fearful when others are greedy and greedy when others are fearful. This mindset allows him to stay focused on long-term growth rather than reacting impulsively to short-term market movements. Buffett also follows the rule of investing in what he understands. He avoids overly complex industries and instead focuses on simple, strong businesses with clear revenue models. This strategy has led him to invest heavily in companies like Coca-Cola, Apple, and American Express, brands with long histories of success and consumer loyalty. One of Buffett's most famous investments was his decision to buy Coca-Cola stock in the 1980s. While others focused on short-term market trends, Buffett recognized Coca-Cola's enduring global appeal and strong brand presence. He still holds the stock today, having earned billions in dividends and capital appreciation. Buffett's investing style is in stark contrast to AI-driven investing, which relies on algorithms, big data, and machine learning to make split-second decisions. While AI can analyze patterns and optimize portfolios with incredible speed, it lacks the human intuition and business insight that Buffett has honed over decades. His ability to assess leadership, brand strength, and long-term economic stability gives him an edge that no algorithm can fully replicate. His track record proves that a well-researched, fundamentally sound investment strategy can outperform even the most advanced financial technology. AI-driven investing represents a completely different approach to wealth generation than Warren Buffett's traditional value investing strategy. Instead of relying on human judgment, AI uses algorithms, big data, and predictive analytics to make investment decisions in real time. AI does not have emotions, biases, or the need for patience. It strictly operates on numbers, historical trends, and probabilities. This allows AI-driven investment models to process vast amounts of data in seconds, executing trades with speed and precision that no human investor could match. By analyzing market patterns, economic indicators, and corporate financials, AI identifies opportunities and risks at a level of efficiency that would take human analysts weeks or months to accomplish. One of AI's most powerful capabilities is algorithmic trading, where it detects market price patterns and executes trades automatically. These algorithms can analyze stock price fluctuations, economic reports, earnings calls, and global financial news to predict market trends before they happen. Unlike human investors, AI doesn't hesitate or second-guess decisions. It reacts instantly based on data and probability models. This method eliminates the psychological pitfalls that affect human investors, such as fear-driven selling or impulsive buying. AI ensures that every trade is executed purely based on statistical advantage, removing emotions from the equation. AI also thrives in high-frequency trading, a technique where stocks, currencies, and commodities are bought and sold within milliseconds to capitalize on small price movements. Hedge funds and investment firms that use AI-driven high-frequency trading have an advantage over traditional investors because they can exploit microsecond delays in stock price fluctuations. These trades are impossible for humans to execute manually, but allow AI-driven firms to generate profits on an enormous scale. Renaissance Technologies, one of the world's most successful hedge funds, has consistently outperformed the market using advanced AI-driven trading models, something Warren Buffett has never relied on. Another major advantage of AI is data-driven portfolio optimization, where AI systems analyze thousands of companies in seconds to find the best investment opportunities. Unlike human investors who may spend days or weeks researching a single stock, AI can simultaneously evaluate multiple markets, identify undervalued stocks, and adjust portfolios in real time. This continuous optimization helps AI-powered investment platforms, such as Betterment, Wealthfront, and Pionex, offer diversified, low-cost investment strategies that are always adapting to market conditions. AI also employs machine learning predictions to refine its investment strategies. By analyzing historical data, AI models continuously learn from past successes and failures to improve future trades. The longer an AI system operates, the smarter and more precise it becomes, making real-time adjustments to maximize returns. This constant learning process allows AI to identify market inefficiencies, predict downturns, and take advantage of hidden opportunities that traditional investors might miss. While AI investing has proven highly effective in certain areas, it also has limitations. AI lacks human intuition and an understanding of qualitative factors like company culture, leadership strength, and geopolitical risks, elements that Buffett considers essential in his investment decisions. However, as AI continues to evolve, it is becoming an increasingly dominant force in the financial world, offering a fast, data-driven, and highly scalable alternative to traditional investing strategies. The question remains, can AI's cold, calculated precision outperform the wisdom and experience of a seasoned investor like Warren Buffett? When evaluating who wins the investing game, Warren Buffett or AI, it's essential to look at performance metrics, risk management, and consistency. Buffett has built his fortune through disciplined value investing, focusing on long-term stability and strong fundamentals. AI-driven investing, on the other hand, relies on algorithmic trading, predictive analytics, and automation to generate fast, data-backed decisions. While both strategies have outperformed the market, they do so through vastly different methods. Historically, Buffett's Berkshire Hathaway has achieved an average annual return of over 20% since 1965, consistently beating the broader market. AI-driven hedge funds, such as Renaissance Technologies' Medallion Fund, have reported annualized returns exceeding 30%, but these funds operate under highly exclusive conditions, making their strategies difficult for retail investors to replicate. Meanwhile, the S&P 500 index averages about 10% per year, serving as a baseline comparison for investment success. While both Buffett and AI outperform this benchmark, their approaches cater to different types of investors. Buffett's strength lies in long-term wealth building and resilience during market downturns. He relies on fundamental analysis, carefully evaluating a company's financials, leadership, and market positioning before making a move. His investment philosophy is centered on buying undervalued companies and holding them for decades, a strategy that has paid off immensely. For example, Buffett's decision to invest in Coca-Cola in 1988 has resulted in billions of dollars in dividends and capital appreciation. An AI system, in contrast, might have frequently traded Coca-Cola shares based on short-term fluctuations, missing the compounding effect of a long-term hold. AI, however, has significant advantages in speed and efficiency. Unlike Buffett, who relies on manual research and qualitative assessments, AI can process millions of financial data points in seconds, identifying patterns that human investors might overlook. AI excels in high-frequency trading, HFT, where it executes thousands of trades per second to capitalize on minor price fluctuations. Furthermore, AI eliminates emotional biases, preventing panic-driven selling and impulsive investment decisions, two of the most common mistakes made by human investors. One of AI's biggest advantages is its ability to adapt instantly to market conditions. It can adjust portfolios in real time based on economic indicators, interest rate changes, and geopolitical events. Buffett, on the other hand, follows a more static approach, often choosing to hold onto investments even during turbulent times. AI-driven hedge funds, like Renaissance Technologies, have used algorithmic trading to deliver higher short-term returns than most human investors, including Buffett. Ultimately, choosing between Buffett's human-driven approach and AI's data-driven investing depends on an investor's goals and time horizon. AI is better suited for short-term, high-frequency trading, where its speed and efficiency provide an edge. Buffett's approach, however, is ideal for steady, long-term wealth accumulation, where patience and deep business insights lead to sustainable growth. For most investors, a hybrid approach may be the best solution. AI can be leveraged for data analysis, automation, and execution, while Buffett's principles can serve as a foundation for long-term portfolio growth and risk management. Rather than viewing AI and Buffett as competitors, the best strategy might be to combine the strengths of both, using AI for efficiency, while applying Buffett's timeless wisdom for wealth preservation. As AI continues to advance and refine its investment capabilities, many wonder if legendary investors like Warren Buffett will become obsolete. While AI has already disrupted many areas of finance, completely replacing human investors, especially those with Buffett's level of expertise, is unlikely. Investing is more than just analyzing numbers and patterns. It involves understanding human behavior, economic cycles, and long-term business fundamentals, which are areas where Buffett thrives. One of Buffett's greatest strengths is his deep understanding of human psychology and market behavior. Unlike AI, which processes raw data and executes trades based on algorithms, Buffett factors in leadership quality, brand loyalty, and consumer sentiment, elements that are difficult to quantify with numbers alone. His patience and ability to resist short-term market noise allow him to make decisions that stand the test of time, while AI-driven trading models often focus on short-term optimizations that don't always translate into sustainable growth. AI might be able to detect statistical correlations, but it lacks intuition and the ability to assess qualitative factors that shape a company's future. However, AI's potential in the investment world cannot be ignored. It is already being used to enhance investment strategies, optimize asset allocation, and identify new market opportunities faster than human investors can. AI's ability to analyze millions of data points in real time gives it an edge in high-frequency trading, portfolio rebalancing, and risk management. As technology advances, AI will likely continue evolving, incorporating more sophisticated machine learning models that may better predict economic downturns and company performance. That said, AI still struggles with unpredictable economic events, shifts in public sentiment, and black swan occurrences like financial crises, factors that experienced investors like Buffett can navigate more effectively. For modern investors, the best approach may not be choosing between AI and Buffett's strategy, but rather combining the strengths of both. AI can provide unmatched data-driven insights, risk assessment, and automation, while Buffett's wisdom and long-term vision ensure that investment decisions are not solely driven by numbers, but by deep business understanding. Many investors today use AI to process information and optimize portfolio management, but ultimately rely on human judgment to make strategic decisions based on real-world experience and economic intuition. AI is undoubtedly transforming the investment landscape, but human investors like Buffett still hold a unique advantage in areas where intuition, patience, and human reasoning are essential. The future of investing may not be about AI replacing Buffett, it may be about AI working alongside human investors, enhancing their ability to make informed and strategic financial decisions. So, who wins the investing game? AI or Warren Buffett? While AI has an edge in speed, data analysis, and short-term trading, Buffett's proven strategy remains undefeated in long-term wealth building. But what do you think? Will AI eventually surpass human investors? Let me know in the comments. Don't forget to like, subscribe, and hit the notification bell for more insights on finance and investing.